This is problem 15.8 from Chapter 15 of Brigham and Houston's Fundamentals of Financial Management, Concise 9th edition, and we're looking at current asset investment policy. This firm is expanding and wants to consider the cost-benefit trade-off of either restricted policy, moderate policy, or relaxed policy for current assets, and that has to do with how many you keep. A relaxed current asset policy means you hold a lot of inventory, give a lot of trade credit. A restricted policy means that, well, we don't do so much with the accounts receivable, or we don't give as much trade credit, and we don't hold as much inventory. And then the one right in the middle is just right, the moderate policy. So we want to calculate three different scenarios in here. I'm going to freeze the panes and then start out with write down what I know, and it's going to be more or less the same for whether it is a restricted policy, a moderate policy, or a relaxed policy. A lot of these numbers be the same no matter what. Some of the other numbers are going to change, so we'll just try and compute it as we go. But first things first, start writing down everything you know. All right. We expect sales to increase to $2 million. So $2 million in sales no matter what. Fixed assets will be $1 million. Fixed assets, regardless of how flexible we are on current assets. And we're going to maintain a debt ratio of 60%. So the debt ratio, debt to assets or liabilities to assets, is going to be 60% no matter what. All right. So and the interest rate, or the interest rate is the cost of debt, is going to be 8%, regardless on, and the 8% applies to both short-term and long-term debt. Three alternatives are regarding the current asset levels. Okay, so the current assets are either going to be 45% of sales. I'm just going to leave that. Current assets over sales. 45%, 50%, or 60%. All right, earnings before interest and taxes, operating income, should be 12% of sales, EBIT over sales, so it's the operating profit margin, and the tax rate is going to be 40% no matter what. All right, so what we want to be able to do, management wants to know the optimal level. So given all this information, what's the return on equity? And then we'll just talk about the others are discussion. So the ROE, part A, is the part that we can calculate in numbers. That's what I want to know, net income over equity under each of these policies. All right, so that's the first thing I'm going to solve for, okay, for part A. All right, so let's look at current assets. as a function of sales. Sales times the current asset over sales ratio. It's either going to be 900,000, a million, or a million two, depending on which policy we use. The fixed assets are going to be the same no matter what, and those are a million. So what that's telling me is that total assets are going to be either 1.9 million, 2 million, or 2.2 million. Of those total assets, the liabilities are going to be the debt to assets ratio. Debt to assets, total liabilities to assets, 60% no matter what. So liabilities will differ under the plan, which means that the equity will differ under each of these plans. If I take total assets minus the liabilities, that'll give me the equity. So what I need from here is what the net income would be. Well, I'm given the operating profit, earnings before interest and taxes, is going to be 12% of sales no matter what. So there's my operating profit. The interest is going to differ though, because I'm going to have a different level of liabilities. So it'll be 8% of a different number under each of these plans. This is treating all liabilities as if they are interest bearing. That'll give me the taxable income. Taxes at 40% equal to EBIT, equals to that times 0.4, which gives me net income, taxable income minus the taxes. Alright, I'm just going to copy that over. So the net income will either be 89,280, 86,400, or 86,440. The equity will be either 760, 800, or 880. So my net income divided by equity, net income and divided by the equity. Format those for a couple of decimal places. So the optimal structure would be to have a restricted policy that gives you the best return on equity. That's not necessarily, part B and C talk about, that's not necessarily optimal though. Let's go back up here, and in this problem we assume that its sales are independent of current assets. Is that a valid assumption? Why or why not? Well, think about it. If you don't have as much inventory with this restricted policy, people come in there to shop and they ain't got their stuff, or your customer calls up and I say, I need 3 cases of widgets. You say we don't have any. They're going to go shopping somewhere else. So the amount of inventory is going to affect sales. Also, your credit policy. That's, let's say we give them 30 days same as cash under the moderate policy and 10 days same as cash under the restricted. Well, where would you rather shop? A place that gives you 30 days to pay, or a place that gives you only 10? So sales would actually be affected by the trade credit policy as well as the inventory levels. That's why we use different policies, is because the idea of having a less restrictive net working capital policy is to spur sales. So they're not independent, and so those are not valid assumptions for any host of reasons. Part C, how would the firm's risk be affected by different policies? Well, the more trade credit you get, the riskier it's going to be that you can't meet, that somebody will not pay you. So having more accounts receivable makes it riskier that you won't have enough money or won't be able to collect all the money or that somebody stiffs you. Conversely, the less inventory you have, the bigger the chance that you'll run out of inventory. So the risk is affected by these policies, but we don't have really good numbers to explain it. And finance people don't like anything you can't actually calculate with a formula. But risk is one of those subjective things, and it would actually affect these decisions quite a bit. All right, but Part A, the answers, the ones that are in the back of the book, those are the return on equity ratios for the three different policies, given these really restrictive and unrealistic assumptions.